Okay, hi. Friday morning. I'm finally getting this movie done on Friday, not on Saturday. Um, anyway, um, hello. Just a quick recap of week three and then on to week four. First, I guess an apology that I wasn't really involved in the discussion forums as much as usual this week. I had hoped to catch up on Thursday, particularly in the evening, but that didn't happen. And I apologize for those who had to cancel out last night's phone calls. Everything's fine, um, but I had to be somewhere because someone was in the emergency room. So enough about that. Everybody's fine, but I'm sorry I wasn't involved as much this week as normal. Hope to do better next week. So, those who I had to cancel out on last night, hopefully we can maybe just reschedule for Monday in the evening. I actually have obligations Tuesday and Wednesday evenings, and we should talk sooner rather than later. So, why don't we just say that we'll move last night's appointment or phone calls to Monday night, and for those of you who cannot do that, just give me a ringy ding. I don't know, just give me an email or a ringy ding, and we'll find a different time. Okay. All right. So, what about the discussion forums in week three? You did fine without me, actually. But the first two are essentially about whether anybody's going to come to your organization's aid if, in fact, you screw up financially. The first question directly goes to that in terms of bailouts. The second question goes to that in terms of possible collaborations. And collaborations typically come about when one or another organization's not doing so good. Right? You fix the hole in the roof when it's raining. No, fix it when it's sun shining. And think about collaborations when you are strong and you can collaborate with a strong partner. But truth be told, in my way of thinking, I think lousy nonprofits that are not good financially and not good, and correspondingly typically not good operationally, they should die. The whole point of the nonprofit sector is to provide for the public good. And if you can't do it well, get out. Let somebody who is good at it do it. All right, that's just me. But I think the other part there is simply that financial matters really matter to nonprofits. And so you have to make sure that you're getting this right. You have to make sure that you're learning this basic information. And at the latter part of the course, you have to understand how to make good financial decisions so that your organization really can blossom. It really can provide that quality public service that you get tax benefits for, and for which the public continues to give you tax benefits for, so that you can basically do your part of this public trust, right? The public trusts you to be a good nonprofit. That's why they give you tax benefits. But if you lose that public trust, then there's no reason why the public can't take those tax benefits away from you. Okay? And we see this sort of encroachment happening currently, right? Where strapped local municipalities are increasingly looking at pilots, payments in lieu of taxes from nonprofits. And we also periodically at the state and federal level hear about the tax deductibility of contributions to nonprofits being curtailed or doing away with. So Just because we have those tax benefits don't mean they're going to be there forever. Okay? All right. So ends the diatribe. Okay, and in the third discussion forum, we talked about the Oceanside and its accounting problems. Yeah, the whole point of that exercise or that PowerPoint and case study PowerPoint and this discussion forum question is to highlight that you need to make sure you have someone on your staff who really knows accounting well, the mechanics of accounting, meaning, where do you put transactions, in what sort of box on the financial statement and on the chart of accounts do they actually go. And if you don't have somebody who can do that, you're going to be making financial decisions based upon reports and statements that are wholly inaccurate. And my last question at the very end of that forum had to do with, well, if Oceanside only makes $200 a year anyway, apart from anything else, would you give them a loan? Well, how much money does $200 actually support? In other words, if you used all of that $200 to make interest payments, how big a loan could you actually support? And Nina did a nice job at the end there figuring that out. And I think someone else, I see your face, but I can't remember the name, also took a stab at that and did a good job as well. Okay? But the answer is $2,000 loan at 10% interest. That's not a big loan. So apart from all of the other reasons why you would or wouldn't, and under what circumstances you would or wouldn't give Oceanside a loan, remember the number says it can only afford a $2,000 loan. And at that's only repaying the interest. Okay, and then we're on to number 4, about the 990s. And I just put a post there this morning that I hope you will take note of. Understand, and you'll learn this in 665, the law and policy course. Houses of worship, 501c3 houses of worship, do not fill out 990s. And so just know that our discussion has been and was totally focused on secular 501c3s. But I make that point, one, to make that distinction clear, and two, to let you all know that at the moment there are bills in the House, in Congress, and the White House is making noise about doing away with the Johnson Amendment that was put in by President Lyndon Baines Johnson when he was a senator, and it was either 52 or 54, I don't remember, because I was either just born or 2 years old at that time. But the amendment said that nonprofit 501c3s cannot use any of their money to influence elections. Okay, you can't make, you can't take out campaign ads. You can't contribute to campaigns. And so, if that amendment is done away with, campaign contributions will be able to funnel through houses of worship and dummy organizations that say they're houses of worship, and there will be no public record of where the money's coming from and where the money's going. And that, my friends, will be the death knell both of the sector being only there for the public good, and it will really damage severely our democracy. And in my post, I make this little point, and I'm a little passionate about this because, I was a college kid when Watergate occurred, and so I know, and Spiro Agnew, right, the vice president had to resign because they found a bag of money on his desk, and it was a payoff while he was vice president. Okay, so slush funds of campaign contributions that can't be tracked in any way from the public, it corrupts the donor, it corrupts the recipient, and it totally undermines our democracy because we don't know who's paying what to whom for what outcomes. Okay, get off the box. What else do I have here? Oh, the other side of that Johnson Amendment. What would you do if you were a nonprofit executive and a politician comes to you and says, "I want your organization to donate to my campaign"? Well, if you had no government funding, you could just blow the guy off. But 25% of all nonprofit revenues come from the government. And if you're in the human services field, it's probably, 60% of you have more than 50% of your funding coming from the government. You're going to get shaken down all the time. The sector will be done. So keep your eye open for that. Okay. Then we had 2 assignments, and I'm already at 11 minutes. I'm sorry. 2 assignments. The net asset assignment, you all basically aced. One person had a little trouble, but the assignment's there for 2 purposes. One, those of you who say you're not good with numbers, forget it. You just did enough algebra, that all the algebra and all the mathematics that's really required for the course. So you did fine. The other point is that understand that your profitability in one year is going to affect your net worth at the beginning of the following year, right? So that net assets, your profit or loss in the year, affects your wealth either up or down, right? And so that's why net assets is used. There is a connection between the net assets on your statement of activity and net assets on your statement of financial activity. Okay? And then just the other assignment had to do with the creating charts of account. And I guess that's there more than anything. It's there because when I went to one nonprofit, we had to create a whole new chart of account for a $50 million total budget and 5 different organizations. And I didn't get taught in graduate school how to do chart of accounts, so I was a little lost, figured it out, but thought I'd give you a little bit of experience with it. The one thing to note is that many of you got the total assets number wrong. So I took off a 1/10 of a point. But the point being that remember that there's a convention that all totals have to end in a series of 9s, right? And so if you think about if assets start at 10,000, then the very, 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 very biggest number that you can have before going into the 20,000s should be the number you give to total assets. Because you want every account number in between to get added up when you go to total assets. And so the number there was 19999. Okay? 19,999. Okay? Not a big deal, but now you have some experience with chart of accounts. Okay, so this coming week, week 4. This week we're going to look at financial ratios. And financial ratios are simply ways of taking specific dollar values off of the financial statements and comparing them so that you can figure out what's the financial state of this organization. Okay? And you'll see that Zietlow has his set of financial ratios, And I purposely gave you a second set by Anthony and Young. Okay? And if you read other financial textbooks, you'll get even more ratios. Okay? Every expert seems to have his ratio that's better than anybody else's ratio. Okay? But there is common agreement, on the basics. In other words, ratios talk about profitability, they talk about liquidity, and they talk about the long-term, short-term and long-term solvency of the organization, whether it's for-profit or non-profit. And so you'll see on some of the sheets then that I group different specific ratios in those big categories. And I guess the other thing to really say here is that there are a handful of ratios that everybody considers important, whether you are, irrespective of which expert is talking. Okay? And so those are the ones we focus on in our exercises during the week. And so, okay, so how do you do ratios? Look at the group care example in the supplementary readings this week. Okay? And when you look at those, particularly the third PowerPoint in the segment that is group care, make sure that you run it as a slideshow, starting at the first slide, and then just press the down arrow. Okay, up arrow if you want to go backwards, but the down arrow if you want to go forwards, and it will show you meticulously back and forth between the ratio answer sheets and the statement of financial position and the statement of activity, and where you get the information from in order to go into the numerator or denominator of the ratios. Okay, so that will hopefully help you do the mechanics of how you do ratios. Okay, and you get 2 chances this week to do ratios well. Note that assignment 5 is due on Wednesday, and I will correct them, get them back to you right away, and that SBA 6 is due on Friday. Okay, it's really important that you know the mechanics of this, and then, as you'll see in the discussion forums, to be able to then look at the ratios and the ratios over time, a series of years you'll have the data for, and then to be able to look back at the financial statements over a series of years and see how things are changing. This is really the crux of now moving from just mechanics into analysis and understanding the story that a series of financial statements over time can tell you about what an organization has done. And in the assignments and the discussion forums, what you need to really look at is the reduction in liquidity. Okay? The reduction in liquidity, meaning the cash position of the organization we're going to be looking at declines. Not the total assets, but the liquidity of those assets go down and down and down. And so you want to really focus on that and figure out, well, why did it go down? And if my total assets have remained constant over time and maybe even gone up, but my cash has gone down, well, where did the cash go? Okay? All right, that's enough of that. I guess that's it. God, 20 minutes right now. Okay, sorry. Okay, take care. So I'll talk to those I didn't get to talk to last night on Monday night, and we'll go from there. Okay? Thanks. And for those who have called, you know the number works. I really enjoyed talking with you. Call anytime. Okay? All right.